Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about some potential tax moves that are coming as Parliament returns. So there's three tax rules that are possibly changing that were kind of put on the table through the election to change, some by Liberal, some by NDP. We want to go through these three tax changes, if they come into fruition, and how you maybe sidestep them or prepare for them as best you can moving forward. Before we jump into the content, I just want to mention we have put on our financial planning masterclass for Canadians on sale, 50% off for Black Friday week. So if you haven't looked up that, we put a link below, check that out. So the masterclass is built for kind of that 20 to 45-year-old group, okay? If you're 45 plus, getting closer to retirement, that course is not geared for you. It's really geared for that 20 to 45-year-old. Talks about savings and buying a first house and RSP, TFSA, budgeting, loans, credit cards, all that kind of stuff. Everything that we should have learned in high school is basically put into 100 videos, content, downloads, everything like that. So we have it on sale till midnight Friday for $199, regular $399. So if you're interested in that, or maybe you have someone in your family, friend, coworker, someone that could really benefit from just getting the basics of financial planning, financial education, links below, check that out. So if we look back to the federal election in September, obviously the results of the election were very similar to 2019. The Liberal government got in with minority, with the NDP Conservative kind of breathing down their necks behind. But I think what's going to be different moving forward, like we see every time there's an election, is different, tax changes that come into effect. So that's what we want to talk about in this video. Since the Liberal government still holds that minority government, they're going to need some, support to be able to get through anything, to pass anything, into place. So the likelihood is that they're going to partner with or team up with NDP moving forward on some of their stuff. Okay. Now, a lot of the platforms that they stood on going through the election process were similar. That Liberals and NDP. Yes, they're very different, but they had some things that the underlying pieces, especially on the tax side, there were some similarities there. So that's, again, what we want to focus here on in this video, because I think those are the most common or the most likely to come into fruition moving forward that could affect you. So the NDP's election platform had two big changes, one minor, one really big change. So we'll level them out at two big changes. But the first one is federal tax rates. Okay, so the highest marginal tax rate bumping from 33% to 35%. So if you're making $216,000 or above, which I get, most people in Canada are not making this, but if you are, expect to see a little bump in your tax rate on the federal side from 33 to 35%. I know most of you watching this video are like, boo-hoo, those people have to pay a bit more taxes. I agree. I think it's good that the wealthy pay more taxes. That already is the case. A little bump in tax rates. We have a large debt in Canada. I think that's a good way to start paying down that debt on a personal side. What this tax change means, though, is that if you're in the highest tax bracket, in some provinces, you're going to be paying as high as 56% in taxes now. So if you are a high income earner, which I know we talked to many of you that are, and maybe it's not, your employment income's not that high, but we talked to a lot of you that have bought Shopify or Tesla stock, 3, 4, 5 years ago. And now you have a non-registered investment portfolio worth millions of dollars, okay? So be aware of that. If you sell your Tesla stock in there and you're buying, stuff that generates income or dividends, you could fall into this high tax bracket. And we see that all the time. People have made, $50,000, $60,000, $70,000 their whole life. They hit a home run on, ideally Tesla has been the main one, but now it bumps you into that high tax bracket. So be aware of that. It's not just for kind of the high income earners. It's potentially for you. You hit a home run down the road, you could be paying this tax bill. But some provinces now up to 56% at the highest marginal tax rate. So that's a lot of tax going out of the door on every dollar earned. The second piece on the NDP election platform was the capital gains inclusion rate. So currently in Canada, we have a 50% inclusion rate. Now, what does that mean? Okay, if you buy a house, let's say you buy a rental property, okay, not a principal residence, but a rental property, and you pay $100,000 for it. I know this, it's not realistic because we're in Canada, but you pay $100,000 for the house and you sell it for $200,000 down the road, okay? You have made $100,000 of gain, okay? When you sell that house, currently, that 100,000, only 50% of it is included. Okay, it's a capital gain, and there's a 50% inclusion rate. So you include 50%. Okay, so if you made $50,000 of earned income for the year, then you sold this rental property, you would add that other 50,000 onto your income. So you'd have a total of 100,000 for the year. 50 from employment income, 50 from the sale of this property. Okay, so again, that inclusion, that 50,000 inclusion, people always ask me, like, what tax rate's that at? Well, it's added to your income in that year. And this is why when you fast forward into retirement, when you sell your rental properties, if you have them, or anything that has a big capital gain, the timing of that makes a lot of difference. Okay, so if you hold, let's say, rental property and you're thinking about selling it and you're also, close to retirement, you may want to consider selling it, a year or 2 years into retirement when your employment income has dropped off the map, so you don't automatically fall into the highest tax bracket from dollar one. Okay, so again, inclusion rate's 50%. Now, the NDP platform was talking about moving it from 50% to 75%. So, same illustration, you sell that rental property for $200,000, you've made a $100,000 gain, $75,000 is now added to your income. Okay, so instead of $100,000 income, you're at $125,000 of income. So you're paying tax at a high rate on an extra $25,000. So you're losing about, depending what province or territory you live in, 40 to 45, or about 38 to 45% in taxes. Okay, so let's say 40% tax. So of that 25,000, you're losing 40% of it to taxes. Okay, that's a lot of money. That's a lot of extra money out the door. So if you own a rental property or a non-registered investment account with capital gains, moving forward, if you sell that, there may be a change coming. Okay, so if you're sitting in a spot right now where, look, you have a rental property, you have a non-registered investment account, or anything that's going to trigger a capital gain, and you have a large gain, an unrealized gain sitting there, you may want to consider selling that property. Okay, so if you have a rental property and we're thinking about selling it in 2022, well, and you have a big, let's say you have a $500,000 or $1 million gain on that, which, if you've bought in 5-10 years ago, there could be $1 million gain on that property. Well, let's say there's $1 million gain right now. You're going to pay tax on $500,000 of it. And if you have a spouse or common law partner, you can split that 50-50. Going forward, that may jump from $500,000 to $750,000. Okay, that could mean an extra $120,000 or more in taxes paid. Okay, I'm not saying rush out there and sell your non-registered account and trigger a gain, or sell your rental property. It's got to fit into the overall plan. But if you're thinking about selling it soon anyway, you may want to consider selling it before these new tax changes are enacted. Now, we don't know if they're going to be. They have to pass legislation. They have to be put in place. But there's been a lot of talk internally about this happening. Every accountant I talk to says this is coming down the pipeline, guaranteed. It's the lowest hanging fruit, and the government has a lot of debt to pay off. So what do? They usually go after the lowest hanging fruit. So I would expect this to come. And the planning around it, again, if you're planning to sell that rental property soon, maybe consider it selling now. If you have a non-registered account with a big gain, maybe sell some of that stock now, trigger the gain now, pay the tax now, try and level that out over time. So just be aware, the inclusion rate could go to 75%. I've also heard it could go to 100. I don't know if we'll get there right away, but I think that's coming down the pipeline as well. So we might go from 50 to 75, eventually from 75 to 100. So plan accordingly. So far we have tax rates, federal tax rates at the highest level, going from 33 to 35% potentially. We have the capital gain inclusion rate going from 50% to 75%. I think this is going to have a huge impact. If that rolls out, which I think it will, timing, who knows when, but when it rolls out, I think it'll have a massive impact on a lot of you watching this video. So be aware of that. Make sure you plan accordingly. Now again, you're planning for something that you don't know if is going to come to fruition, but that's kind of how financial planning has to happen. We have to, kind of look forward and put some assumptions in place. This would be an assumption that I would put in place. If I had a rental property that I was planning to sell anyway and not hold long term, I would probably be selling it now. That's my personal opinion. So the third tax rule or tax benefit in this case is the first time savings or first home saving account. Okay, so the Liberal government had platformed on this, and basically it's a savings account for people under 40 years old to save $40,000 for their first home. Okay, And I'll break this down. It essentially works a bit like an RSP and a bit like a TFSA, okay? You can deposit up to $40,000 into this savings account. It's built for your first home, okay? So if you've never owned a home before, and I assume they're gonna use the rules much like the first-time home buyer, where if you haven't owned in the last 4 years, I think that's how they're going to use it. But essentially, if you've never owned a home before and you're saving up for a home, this is a savings account. You can put money in, and it works like an RSP. So you get a tax break coming out. So it's tax-free money going in, pre-tax dollars going into this account. It grows tax-free, and you can pull it out tax-free as well. And you'll never have to repay it, okay? So with the first-time home buyer, if you pull out of your RSP right now for your first-time home buyer, yes, you get the tax break going in, you can pull it out, but you have 15 years to pay it back, okay? This account is gonna be structured where you get the tax break going in, you pull it out tax-free, and you don't ever have to pull it out. So it's a really beneficial account. Like if you're looking to save, it's gonna help the young people with the real estate market going through the roof. And I talk to many of you say, I don't know how my kids are going to get into real estate. I'll probably have to help them out or whatever. An account like this will be, a big benefactor, okay? So it'll be a huge help moving forward because you get, it's pre-tax dollars that you're saving. If you make if you make $10,000 at work, you can put $10,000 into this account and pull it out tax-free, and it grows along the way. You don't need necessarily the RSP or tax-free savings room to, enable this benefit. So when I say it uses a combination of RSP and TFSA, you get the tax break going in like an RSP, and you get the money tax-free out like a TFSA, okay? If you were just to put money into a TFSA, that's after-tax dollars that you're savings. If you were just to put money into an RSP, yes, you're getting the tax break going in, but you're paying taxes coming out, okay? So that's where it's a combination of the two accounts. And I think this is hugely beneficial for that under 40 market that is looking and working so hard to save for that first home. If you're watching this video and you're under 40, if they put this account into place and you're hoping to buy a home here in the next few years, utilize this account. It's going to be a great account to save into to maximize the benefit of every dollar that you earn and you save up for that home. Now, a couple drawbacks with this account, and this is where some clarity needs to be put forth. Again, this was part of their election platform. All the details weren't rolled out, but essentially $40,000, that's great. But if you're buying in Vancouver or Toronto markets or an expensive market, $40,000 doesn't get you very far. Okay, if you're going to look to buy $1 million plus home, $40,000 doesn't even meet your down payment requirement. Okay, so again, the concept and the idea of this account is great, but I think it actually has to be a bit bigger than 40,000. Maybe 50, maybe 75,000 would be ideal. I think 40,000 is a little low. A lot of markets, sure, 40,000 works. But if you're looking to buy in the Vancouver, Toronto area where a lot of the commerce happens, so I think that helps government and taxes and all that even more. I think they need to bump this up from 40,000 just because 40,000 doesn't get you very far in these larger markets. The second thing is integration with your RSP room. Okay, so they have not come out and stated, do you need RSP room to put money into this account? Does it affect your RSP room, or is it totally separate? Okay, is it you're going to have an RSP contribution limit, a TFSA contribution limit, and now this first home savings account limit? Okay, we don't know if there's integration between the RSP limit or not. That hasn't been announced. I assume there's not going to be, but if you're using this first time savings account and it affects your RSP going down the road, that could be part of the conversation as well and the overall financial plan. So consider that as well. So when this rolls out, I think it will. When this rolls out, look at the fine print, see how this works, see how it integrates with your RSP and possibly TFSA contribution limits. Now, how much you can put in. Again, it's 40,000. Can you put in 40,000? If it grows to 100, can you pull out 100, or are you capped at 40? We don't know all these details yet. So if you fall under 40, or if you have a family member that could potentially use this account, share this information with them. And then when the rules come out, make sure you read the fine print, see how it works. When it rolls out, we'll probably put out another video on this just with more detail and the breakdown on it. Because I really think it's going to help those people under 40 get into the housing market. Because I look at my kids and I think, how down the road are they ever going to get? My kids are little. So if I had teenagers right now that were potentially getting in the market in the next 5-10 years, I would have concerns. Like, how are they going to save enough money to buy, in our area here, like, 2-bedroom condos, like $500,000-$600,000. It's ridiculous. So how are they going to get into that market? So again, a tool like this that the government hopefully will bring out will help people save for that. So thanks for joining us in this video. Again, highest federal tax rates, 33 to 35%. the capital gains inclusion rate, and then the first home savings account. And again, for most of you watching this video, it is probably the capital gains inclusion rate that will have the biggest effect on you. Okay, so keep a very close eye on that. If you have something, a rental property, a non-registered account that has a large unrealized capital gain, start planning with that. Meet with your accountant, your financial planner, map out a tax strategy where maybe you start, winding those down before these rules are put into place. Again, they have to go through legislation, but a lot of time these rules will get, passed and put in place like that. Okay, it's not a long drawn out process. It's as of today. If you sell your rental property or if you sell your stock and have a capital gain, your tax, the inclusion rate is 75%, not 50%, okay? That we're probably not gonna have a lot of heads up when it comes to a big change like this. So just be very, very aware of that. So thanks for joining us in this video. Again, we have our masterclass. If you know someone between 20 and 45 that could use some financial education, it might be a family member, friend, it might be you. Okay, we've discounted that course at 50% off. We only do this once a year, $199 till midnight Friday. So check that out, see if that's the right fit for you. We'll see you in the next video.